Welcome to the first quarter update for our retail business here at Greenleaf. Recapping things, we've been doing this a few years now. We've done 21 retail deals. We currently own 15 that we are operating on a quarterly basis. We're going to touch base a little bit on how they're performing, how they're compared to the market, and what our returns and distributions look like for the first quarter. So we'll get off to things and get started. We're going to start with just general market performance and what we're seeing.
So the National Restaurant Association released its 2024 data, and they're predicting, they basically survey other restaurant conglomerates or companies or franchisors, and 8 in 10 of them think right now that sales will increase this year. So that was the data from at least.
Yeah, we try and find what's the national information saying.
Right, but then there's there's other sources too, like QSR Magazine, the Quick Service Restaurant Magazine. And so they've went all in and said they're
still like a paper publication.
You know what? It's called a magazine, but it's actually like an internet website. It's like QSRmagazine.com because I'm assuming they've actually stopped publishing.
You throw .com on anything.
No .com?
Yeah, I don't know.
Okay. But QSR, I mean that's quick service restaurant. So it's touching base on anything that is kind of in this segment that we're buying.
And it's one of our big resources to actually see how each restaurant performs, their data, what their annual revenue is, their average unit volume. But anyway, they're predicting a 10% growth. Like it's going to go from about $997 billion to $1.1 trillion this year. So that's a pretty good increase for 2024.
Yeah.
I'll take it. I
mean, it's interesting, right? I mean, we're looking at national trend information, and we always look at how do our deals perform against that. Right,
well, if Chick-fil-A is any indication of the market, since 2021 to 2023, Chick-fil-A has seen a 43% revenue increase.
Well, that's because Dave goes there every day.
Yeah, it definitely helps.
I'm fueling the growth of Chick-fil-A.
You're fueling the growth of Chick-fil-A.
Certainly want to help. They're doing well.
But this growth is kind of it's twofold, right? It's like people are shopping and out and spending money, as well as inflation and the cost of goods are going up. Like my same order at Chick-fil-A went from $14 to $18 over a 2-year period. So you're capturing revenue in a couple of different ways.
Yeah, and just to be clear, my Chick-fil-A order still cost me $11. I don't know why yours cost you $18.
I don't know.
The tortilla soup, it's seasonal. It gets me every time.
Yeah, all right.
Well, we look at our stores and we're going through okay, how do ours perform? And we have a mix of asset classes. We have IHOP, Taco John's, Zaxby's, Applebee's. We've got a Panera. So we have a couple different things. And we have our dollar stores as well.
We've got our
in that
DQ.
Mix.
And
Yeah, we have a Dairy Queen, the Grill and Chill, so one of the newer versions of their location. And we don't necessarily get same-store sales on everything, so it's hard to compare that. Some leases require that they provided, others do not, right? So when we look at a consistent data set, we always kind of go back and look at foot traffic, and we say, what does our foot traffic look like on a location? That's a lot how we judge our acquisition criteria. Right, is based on that too.
Correct. Correct.
Yep. And then in just our stores, and again, we're really only in the Southeast. We have got 2 in Texas, but the Southeast, we saw kind of a mixed bag on foot traffic where we had some stores that were up. Our DQ Grill and Show was up 20% from the first quarter of 2024 to from the first quarter of 2023. So 1 year, quarter over quarter change. Our Grill and Show was up 20% on foot traffic, whereas we saw some of our Applebee's were down 3 to 5%.
Right, but don't forget, even though they're down at 3 to 5%, across the board, sales are increasing because of inflation.
Yeah, well, yes, but sales are going up and their revenues are going up simply because they're charging more.
Right.
So a lot of the growth that's been captured in this market is really inflationary growth of saying, hey, we may have the same or slightly fewer or slightly more people, but we're really seeing the big growth dollars coming from just charging more, right? Purely inflation. It's not that people are buying more maybe, or it's not that they've seen a huge influx of customers. It's that they're just charging more. So that's, what we look at our information, what we're seeing from this is national trends saying revenues are going to be up. On the ground, nitty-gritty details are saying maybe foot traffic is flat.
Right, but don't forget there's also the dine down concept where as prices go up, people start to dine down. So an Applebee's customer might become a Zaxby's customer, a very
then
fancy
you would
restaurant.
see higher foot traffic.
Right, then you would see higher foot traffic.
But we're seeing flat foot traffic with higher sales. So we're really just seeing prices that are increasing.
Yes.
So
my dine down option, Chick-fil-A, is costing me more money than my dine up restaurant.
What's your dine-up restaurant from
Mojitos
Chick-fil-A?
cost me $15 with tip and everything
For
lunch.
you.
Yeah, it's amazing.
For your grilled chicken nuggets
Exactly.
Yeah. So there's definitely the price inflation that's still active, and it looks like projected to continue for 2024. Really, I think that's our main takeaway from that. But you have higher revenues. I mean, a lot of our leases are priced off of a rent to sales ratio, right?
Right. So as long as that rent, I mean, a lot of, first of all, when we buy our restaurants, we make sure we do a good job trying to make sure that they're paying enough rent, or they're incentivized to stay there because their rent is not going to be a big portion of their
Yeah, we don't
sales.
want the highest.
Right. We want to be the cheapest
sale
rent,
ratio.
not the highest rent. So usually we try to target and make sure it's that 8% rent to sales ratio or less. And so once they reach that like 8%, some of them are 10%. I mean, that's a good ratio to be at. And that's what one of the industry metrics we look at right now is like, so like our Seneca Applebee's is definitely like, at or below an 8% rent to sales. Our Zaxby's Kennesaw, Zaxby's Powder Springs, they all have good rent to sales ratios right now.
So I think our main takeaway is really that you can probably expect about another 10 to 15% increase in QSR prices for 2024. That's kind of what our initial data is showing. If sales are projected to be up that much, we really think it's just coming from pricing increases.
So then Josh's Chick-fil-A will cost him $19 this year.
It
might go up more
this year, man.
All right, let's go on to our next one here. Distributions are always top of mind, kind of how we're doing, what's coming out.
So we started approaching distributions from a different lens. Well, not necessarily distributions, but the way we look to operate the deals, right? And using this new term, aura.
Yeah, so looking at things from like an operating return on asset standpoint. So it's a metric we can use to compare really all deals equally and saying the asset value we have, what yield is that thing generating? So it needs to be, the more yield it's spitting off, the better the deal is doing. And ultimately that can then be played into like what's our return on equity, right? So you look at our retail deals as a whole for the first quarter, and we kind of have how we did this quarter and what we're projected to be doing. Right now we're trending to do about 8.5% return on equity. So every dollar invested, 8.5% return on that. For 2024, we're at 11% ahead of schedule for the first quarter. So we're happy with that. Our preferred return on the majority of our deals is around 6% on the retail side. So we're ahead of our preferred returns on making distributions. If we add in debt, debt is not we pay down our mortgage. It's not really a distributable event, but it does help when we look at how the overall deal is performing. If we add our debt payments in, we get to around a 12.8% return on equity. If you add in cash available for distribution and debt that's been paid down. So solid numbers in the first quarter. All the deals performing well and hitting our targets. So we continue to just see stable long-term distributions out of the retail business. You want to add anything on that one? It's pretty good right now.
Yeah, yes, we're doing pretty good. And, it's kind of an indicator that we made the right decision when we were buying the deals too. So you have to look at that, pay attention to the rent to sales ratio, pay attention to the sales data, pay attention to make sure the tenant could pay their rent and actually have reasonable sales.
And kind of back to that assessment of buying a deal, we are typically trying to buy deals where we're in the top 30% of foot traffic numbers. So we want to see a location that has a lot of people going into it compared to other stores. So the majority of our stores, that's what we're seeing. They're holding at that. So they're performing well. So distributions go out on the 20th. So they'll be out shortly after that. And they'll hit bank accounts. So we're excited about that. It should be a good quarter for this year. So let's, next point, we're going to dive into just some specific buys and sells, kind of where we stand with the portfolio. We're always opportunistically looking to either capitalize on something that's there or look for a way we can buy something.
Should we talk about IHOP first?
Yeah, let's go into that one first. So
IHOP was, the original business plan for IHOP was going to be a very short hold to begin with. We bought the property, renegotiated the lease. We went from a short-term lease to I think we actually got a 16-year lease out of it. And so the maximum value of the property is always going to be with that 16-year lease. So we were going to hold it for a year to make sure our investors get long-term capital gains versus short-term capital gains, and then list it for sale. Last year, these properties would trade in about 5 minutes for a 5.5 cap. Now with interest rates changing, it changed the market a little bit. And so we're going to probably sell this one for a low 6 cap. So it's not going to be the great home run we thought it was going to be, but it'll be okay.
But at 6 cap, I mean, interest rates moved up by 200 basis points, and it really only impacted this deal by 50 basis points. That's pretty incredible.
50 to 70 basis points. Yeah, that's pretty good. And it's you know, it's a good solid property. And so if we don't sell it, we don't sell it. And if we sell it, great. We make a little money and we move on and we find something different.
Yeah. Just the leverage in these deals when you 50 points, 60 points on a cap rate, meaning it goes from a 5.5 cap rate to a 6 cap, that would be 50 basis point spread right there. Literally every point matters when you think about what's the total IRR on a deal and how that plays out. So we're sensitive, obviously, that we want to maximize returns, generate as much investment income as we can, especially when we have a deal that's performing and we can hold it where there was no kind of gun to our head to sell anything, right? So it's like we want to make sure we're maximizing investor returns and taking advantage of the best we can do in the market. Sometimes that yields 25% IRRs. Sometimes that's 10% IRR.
And so one of the next properties we're looking at selling right now is our Seneca Applebee's. Our Seneca Applebee's, we just got the 5-year renewal. So it's up. It has a brand new 5-year lease on it. And so these are the option periods right now. And so the maximum value that this property is going to have is with this long lease. And so we also put that one up for sale. That's on the market right now, and we'll see what happens with that.
Yeah.
We literally just listed it, I think, just a few weeks ago. So no offers yet, but
but all these is really our business plan in the retail segment is if we have shorter leases, once we extend to a longer lease, it's then we can go test the waters and see if there's an opportunity to capitalize on that value. And really at that point, you're looking at, a basic kind of finance 101 discounted cash flow. Like, do we take the money now? Do we collect the long-term payment? Like, which one is going to provide a better return for our investors? That's the decision we go with.
And our Seneca Applebee's is also probably one of our top performing Applebee's. It's in a lake town area, high traffic, high sales. It's the top performer. So we love our Seneca Applebee's, and it should go for a good price.
Yeah, we talk about top performer based on back to that foot traffic number of like how active is it and what are their sales?
We actually get sales, so we get sales released to us, so we understand foot traffic and we understand sales in this restaurant. And then the next one, Sumter Applebee's, we also have listed that one for sale. That's turning out to be a little bit of a different situation. And the tenant has a 4-year lease left on their 4 years left on their lease right now, and they go back and forth whether they're going to actually continue to stay there. And so we're working with them, trying to get them to figure out, okay, well, do we need to re-tenant the property, or are you going to stay? And so we're having some conversations with them about that, and we'll see where those end up. In the meantime, we've just listed it for sale because it's not in our core portfolio, and problem properties or properties that are going through this type of transition.
Yeah, well, I mean that we bought a deal that had a specific operator in it, and they sold it to a different operator. So now we have basically a new friend that we're working with on a daily basis. Josh, I mean, you spoke to them for a good amount too, right? On what their plans are with the store and how they plan to operate it.
He's laughing, Dave.
But yeah,
I mean, they bought a big portfolio. They're trying to figure out what they have and really where their winners and losers are. The specific team is a little jerky on, is this a winner and loser, and then has that tie to the lease, and then is there enough time for them to turn a loser into a winner? So Sumter is one of those properties that is not one of their better performers, but there's enough time in the lease that it sounds like they want to stick it out and try to make it a winner.
Yeah, and the important perspective on this property is that all of the properties around this property perform really, really, really well. And so this is a management issue. Yeah. This is not like a location issue. So the previous operator didn't necessarily pay attention to it. The current operator arguably may or may not be paying attention to it. So bottom line is if they don't stay there, re-tenanting this building will be very easy for us because there's a business case where everything around this property performs well.
Yeah, we've already had some initial discussions with other potential people there, but we still have 4 years left on the lease, so we still have a ways to go.
A lot of time.
It's too early to really do anything of substantial nature on that conversation. But right now, even with a challenge like that, still paying the rent, still deals working and making distributions. So, you want to touch base on any other ones? I think that covers most of what's going on right now.
Yes.
We think about how we look at a lot of these deals, and we are trying to make a partnership with an operator that we know and we understand how they work and how they see things. And that's really our best cases, is when we have those situations.
Well, I mean, we stopped focusing on broker advertised deals, and we're focusing on partnerships now. We're focusing on getting involved with smart operators, people who know what they're doing, people who could open up multiple locations, and people who need help with real estate. I mean, essentially, that's what we're falling into right now.
Yeah.
And we're going to, Dave and I are going to Vegas in a couple of weeks.
I mean, it's a good each year we go out to the ICSC,
Right.
which really is kind of a brand showcase that just anyone that's franchising is out there and showing what they have to offer and what their platform looks like. So it's a good place to really just kind of see, how the details are working.
Right. And so we're going to be talking to these major brand players like the Qdoba, the Jim and Nick's, there's a rapid fired pizza that I also found too. So we're going to start talking to these brands and helping these franchisees of the brands open up their properties.
Is LeBron James going to be there with Blaze?
What is
Blaze
that?
Pizza? It's all over. It's more West Coast or Dallas Fort Worth.
So we'll add that to the list.
Look for
of calls.
LeBron. He's the tall guy.
I'm making the calls right now.
Yeah.
So
I'm thinking he might not be at this conference. So maybe.
Shaq should be there. I mean, he's on every advertisement, from Papa John's to Carnival Cruise. Yeah, he's the other tall guy.
Yes. Yeah. Okay, one other point that we want to touch base on, it's probably at the bottom of the email announcement we got from the end of the quarter, and we're making a software change on our investment platform. We're moving to a system called Agora, which we're very excited about. It's going to provide a couple unique features that will help make our distribution process smoother. It helps make our investor experience better, especially from a login and transparency standpoint. So we're going to be sending out announcements with that. You'll get enrollment emails where you can log into the new system. We took all of our information from the old system and we have put it all into this one. Again, we were on a system called Juniper. That was our main invest.greenleaf management. It would take you to there to log in. That URL is now going to redirect to this one. So the back end will be a different system and you will have to sign up for that just to activate your account. One nifty feature it has is a lot of our investors, have multiple ways that they have either invested, whether done something through a trust entity or a personal name or an LLC or one of these features. And this will enable a single sign-on that you can see all of the accounts in one location. So we're pretty excited about that. It certainly makes the transparency better from an investor standpoint, instead of being like, hey, what did I do that through and how do I go find it? This is all going to be in one. But same functionality, but it enables you to direct distributions anywhere you'd like. You can have any account linked to it, and it's a seamless process where our investment entities are going to make distributions and flow directly to investor accounts. On the 20th, that's when we're doing it every quarter.
And don't forget, most important, if you receive an email from us saying that, hey, we're moving to a new investor platform, it's legitimate.
Yeah, it's not a scam.
It's
not a
called
scam.
Agora.
It's called Agora.
Agora.
Yes.
But if you have questions, please let us know. We'd be happy to talk about it and go through just kind of what that system change is looking like, and can certainly help you walk through any questions you have. So, cool. All right, that is it for the first quarter of our retail portfolio. Again, we had a very successful quarter. Just about 8.5% is our target right now for return on equity. So we're excited about that. Please let us know if you got any questions, and we can get back to it.